Hey guys, Bob Hertzog, your real estate dad. Hey, I had the honor of having my buddy Lizy in today again to talk about a few things. In this particular episode, we spent time talking about the recent changes that the Fed has made, or anticipated changes that we think might be coming in September, October, and then the December meetings, and what effects that might have on interest rates. So I think you'll get a lot out of it. I hope you enjoy it. And as always, if you need anything, you know where to reach me. Thanks. Hey, Lizy.
Hello.
How's it going?
I'm excited.
Right on. You were in here a couple months ago talking about interest rates and all that good stuff. So it's been a little while, and I thought we'd give everyone an update. As you know, this last week there was some info that came out that got everyone pretty stirred up with the Fed probability of the Fed making a cut at their next meeting in September. From what I understand, there's 3 meetings left between now and the end of the year: September, October, and then December. And I actually wrote a post about it the other day that the CME group, I believe they're called, that did the kind of the forecasting, what they think the Fed's going to do next time, came out with a pretty high number, 96% chance that the Fed will cut rates at the September meeting. And then they retracted that out and said, okay, so September, we think it's 60-some%, and then December, 50-some%. So people like me and a lot of people in our industry and a lot of potential borrowers out there got pretty excited, saying, wow, that would be 3/4 of a point. Gosh, rates are at 6.5, 6.5, 6.6 right now. That could drop us down below 5%. And you're here to tell us that, well, timeout, maybe. Okay, it's not a for sure thing, but I thought it'd be good for you to come in and really not go super deep on it, but just kind of give like layman's terms of what's going on, how are things looking. I'm still super optimistic for what's probably going to happen over the next 6 months or so. I feel better about it now, just in conversations that I'm having with my clients and friends and family members. And I thought we'd bring you in, as kind of the boots on the ground local expert. We're all used to getting our news from God knows where, and people from all over the country, and you're the one that's out there talking to borrowers on a daily basis. You're looking at their credit. You're seeing what's working and what's not. So I wanted to hit on that, and then I wanted to hit real briefly on what you're seeing with the first-time home buyer market, if things are improving at all, or if they're, I know it's still tough for them to find a house out there right now. And then lastly, shifting gears to the senior side of things, where happen to, that's the end of the pool that I swim in a lot lately, just because I've been doing this a while, and a lot of my clients are getting up there in years, and their parents are getting up there in years, and some new decisions being made on caring for the parents and everything else. So anyway, just real quick, like, where are we right now with rates? Am I right? We're at like 6.5, 6.6, 30-year fixed right in there somewhere.
I think that's what Mortgage News Daily is reporting as the national survey. But it's an awesome time for real estate. And I think most people are sleeping on the fact that rates dropped silently about a 0.5% in the
Yeah.
last 45 days.
Yeah.
And that's about $178 to people's monthly payment and about $30,000 in buying power. So
Wow.
it's pretty big, just the movement that we've had in rates. Now, there are a lot of headlines right now, and newscasters, you guys, they're not economists. And while they present the news, they understand it about the same level, maybe 2 degrees more than most consumers. And so when they hear that they're dropping the Fed funds rate, they're like, "Great, rates have dropped," and they pass on this information, and people automatically assume that it's going to impact mortgage rates. And a lot of real estate professionals and a lot of clients are waiting for this. But the truth is, rates for mortgages, they actually react based on mortgage-backed security trading.
Okay.
And the Fed funds rate plays a role, but they're not directly correlated the same way that the Fed funds rate impacts prime,
Mhm.
which is associated with credit cards and HELOCs.
Got it.
Okay, so whatever the prime rate is follows lockstep with whatever the Fed funds rate is. And so overnight, consumers, when they drop the Fed funds rate, are going to be paying less interest on their credit cards, less interest for HELOCs, and that will open up some cash flow for them. Not to mention, it actually lowers the carrying costs for banks, which then will get passed through to consumers because if their carrying costs are lower, they can offer, more competitive interest rates. And that's how it actually gets trickled down. The way that mortgages work is that the Fed funds rate is kind of this indicator for what's happening with the economy.
Mhm.
And while it's kind of like the marker, like in directions, it's like our North Star. But what happens is, like, if the economy needs more stimulus, right? What happens in a time where, like, there's rising unemployment or recession, they drop the Fed funds rate to start providing liquidity in the consumer market, in with businesses, and then they buy mortgage-backed securities. So those 2 things happen at the same time, which drops mortgage rates, which is why everyone's really confused, right? Because they're not together.
Yeah. Let me stop you there for a second. When you say they buy mortgage-backed security,
The Federal
that
Reserve, sorry, the
Federal
government
Reserve.
does
Yeah, okay.
to stimulate the economy. So the economy, like 30% of it is driven by real estate and real estate related verticals.
Right. Right.
So like your insurance companies, your Home Depots, the Walmarts, the paint, the municipalities. I mean, there's a lot that's impacted. So whenever we're going into recession, these are the 2 levers that they pull to just flood the market full of more money.
Yeah.
So,
Yeah, go ahead.
but I do want to say that having more liquidity into the market, reducing the cost for banks will eventually drop mortgage-backed securities, or excuse me, will drop interest in mortgages. And it also drives more interest into the mortgage-backed security market. So mortgages typically trade in anticipation of. So there was a like very high percentage that there's going to be a September rate drop. So we saw that reflect in pricing on Friday.
Right.
Okay, so rates were like in the high sixes, close to sevens, and now they're in the mid sixes, right?
Right.
We already saw that take a place in pricing. And so whenever the Fed actually drops the interest rate, typically in the short run, we actually see it bump up a little
Mhm.
because whatever is good for Wall Street, so whatever is good for banks and businesses,
Yeah.
people will then take their money out of treasuries and mortgage-backed securities, place them in the stock market. So short term, we actually see a bump up. So we see the correction in commentary, we see the bump up when it actually happens, and then it's kinda like a staircase. But just to, like, digress from my nerdiness right now,
Mhm.
the overall picture is that as the economy needs less and less stimulus, meaning that they were keeping this Fed funds rate super high to slow down spending, right? As that's no longer necessary, the spread differential, so the risk between a 10-year treasury note and a mortgage-backed security, it lessens. So, because everything's been so unstable and a 10-year is like the most guaranteed return on investment, all investors have only appetite for this, which is why mortgage rates had to go so high. So, in a normal market with normal spreads with the Fed funds rate, we would actually be closer to like 6%.
Mhm.
And 6% is a magical number.
Yeah.
It opens up the buying opportunities for 3 million additional home buyers. It's huge.
Yeah.
And I don't think that people really understand that. So, like, if I was somebody interested in investing in real estate today, I would want to do it right now that rates are elevated because you have so much more leverage in price and concessions.
Yeah.
And I did this for somebody the other day. If you were buying in 2021, it was like $30,000 more out of pocket to buy in that market than this one because you had to pay over your purchase price, over your appraisal, and you were paying for all of your closing costs and your buyer's agent fee.
Yeah.
Like it was so expensive. So if you were to take that and divide it by the difference in your mortgage payment, it's like most people were 4 to 6 years break even buying in 2021 with a lower interest rate than buying in this market. So this one is one I think people need to capitalize, especially now because you got those big tax breaks too.
Yeah. Yeah. Um, Gosh, I remember those days. I mean, it seems like it was yesterday when we were in COVID and I remember taking a listing for my brother-in-law's parents' home, actually, out in Chandler. We had 42 offers in one weekend. We had to create a spreadsheet just to keep track of all the offers we were having to try to figure out which one was the one we were gonna counter. And when you were a seller, you're in the catbird seat. You know, it's like, "Holy cow, this is incredible." But as a buyer, imagine being one of 42 buyers that put an offer in on a property. It wasn't just me, it was every deal in town. I mean, we'd pull up to an open house, you'd have to wait 30 minutes to get into 'em. And it was so emotionally, like, traumatizing to buyers. They just felt like they had no chance out there because there was so much competition. And that's what I'm telling people now is you've got this 60 to 90 day, and I'm not a, and I don't have the crystal ball, but just in my gut, I would tell myself if I was a buyer right now, you've got 60 to 90 days to get out there and find something before rates start coming down and the buyers come out of the, out of the woodwork again. And we're back into multiple, multiple offers and competition and everything else. So let's say rates in December get down to that magical number, 6%. What do you think's going to happen to inventory? Because there's two sides of the aisle here, right? There's people that think that 6% will get sellers that have been on the fence, that have been waiting to make a move, either to upsize or downsize their home. That's going to be enough to make them make that move. Then there's the other side of it that says, no, that's not going to happen, that we're going to get a flood of buyers and the inventory. We do have a significant amount of inventory now, but that will get eaten up quickly. And then it just comes down to the good old supply and demand where you've got not enough supply and a lot of buyers. Now, do you see prices go up again? Right. So, which camp are you in on that?
So, I mean, it's hard to say because if you're just going on, like, stats, right, everything's always a look back number. The best time to buy historically is 6 months prior to a seller's market. It's very hard to anticipate when that is,
Yep.
but all of the ingredients are set for right now.
Right.
Like, in fact, it was, like, 2 months ago.
Hmm.
And so I think that if I'm a buyer and I'm trying to or a seller trying to weigh this out, I'm looking at how many new families have been created with the number of houses that are actually built. And then I'm comparing that to what inventory is available today and how long would that get eaten up if 3 million additional buyers entered into the pool.
Yeah.
And no matter what way you try to work out the equation, mathematically, there's still too many people who could need houses to the amount of houses actually available. And whenever you have those types of conditions, home values are going to go up. And if you look at what has happened over the last like 4 years, right, when we've seen the market shift, I mean, home values have still gone up.
Right.
Like I bought a house after my divorce and that was in August of 2022. And I sold that house recently because I already met my capital gains. And I'm like, "Oh, shoot, I met my capital gains exemption." And as an investor, that's an important data point for me
You bet.
because I'm not attached to real estate. I use it as how I'm gonna grow my wealth. So I was like, "Okay, it's time to sell."
Right.
And that happened in 2 years.
Right.
So it's very, very dependent on location.
I
It's
was going to say
very, very
your house
dependent
was in a very good location too.
it's dependent on location
Yeah.
and it's depending on, like, how many people can qualify to buy.
Right.
I think the magic number when they did that survey was 5 and a quarter makes the survey was like, everyone wants to move. 6%, I don't know if that's enough, but I know that it's enough for somebody who needs more space. And there's always people having babies, there's always people getting married, there's always people getting divorced, downsizing, and death. Like, I mean, it just
Yeah.
is what it is.
Yeah. So it's probably more likely that a seller that wants to buy a bigger home would be more likely to look at that 6%, even if they're under 4% and go, okay, we're busting out at the seams. We need to, you just never know.
With the tax breaks that we just got, anybody who's moving up from a 500 to 700, it makes all of the sense in the world for you to do that now because half of what your mortgage payment would be increased is now offset by tax deductions, right? You got a permanent deduction up to $750,000 for mortgage interest. Okay, your first 5 years are interest heavy. So when you're going from a 500 to a 700, like more of that interest is now tax deductible.
Right.
Then you get the state and local income taxes, right, which is up to 40,000. So that's going to include your state income tax. It's also going to include your property taxes.
Mm.
I mean, and a lot of people meet that 15,000 pretty quickly when they're buying,
Yeah.
a $750,000 house.
Right.
And then you get to write off mortgage insurance if that is you, right? Most people that are moving up from 500 to 700 typically put down 20% because they have the equity in their previous property. But it is something to consider. I mean, these things, when you're itemizing and you're in a higher income bracket, they make a ton of sense.
Right.
And buying now, especially now, like when you have leverage and being able to refinance, those buyers are going to win. Like when we look back, it's 2018, 2019 markets when we were headed into a recession, when interest rates were at 5%, five and a quarter,
Yeah.
that people won big time. Like if you bought your property in 2019, it's like you won the lottery. Like seriously, your property increased 50%.
Yeah.
Like that's nuts.
Yeah. Yeah. I remember when we did our deal in 21 in the house we're in now, it was so hard. We were at 3%. And I remember coming to you and the best we could do at that time was 5 and a third or something like that. And I thought, oh my God, I'm going up 2%. It's, it wasn't that big a deal. I mean, at the time it was a big deal, but, um, I'm kind of like, I'm with you. I don't know that 6% is enough to get, what do we have? 2/3 of homeowners are under
It's enough to get
4%.
buyers. And I think that's
Yeah. Oh, it's definitely enough to get buyers, but I'm talking about the sellers.
But I think sellers are motivated by supply and demand too.
Yeah.
Like, I think it starts with the buyer market. It starts, "Oh, I can get how much for my house?"
That's the
And
other big
that's the
thing.
thing that drives them to sell.
Yeah.
And so, I don't know if it's going to be like the skyrocket rise that we saw with 2020 and 2021. I'm not clairvoyant.
Yeah.
Like, I could just
Yeah.
be like, "Okay, if these things happen, this is what should happen."
Right. The other thing that's been talked about, and I don't know that they voted on it yet or whatever in Congress, one of the senators introduced a bill that would eliminate the gain. Okay, instead of right now, the capital gains treatment. What is it? You get the first 500,000 for couples and 250 for single. Right when you sell your home, a profit.
Yep.
And there's now talk of trying to
Eliminate that.
eliminate that altogether. Have you heard anything on that? Because I mean, you talk about something that could really get things cranking, because so many people have so much equity in their homes now that bought 5, 6, 7 years ago. Would that be enough, or does it need?
So if rates are elevated like this, they're gonna have I personally think that in order to stimulate people to move, they're gonna have to do something.
Yeah.
Right? And the thing is that we're not out of the woods yet. Like
Right.
we're just not out of the woods. Like we have keep thinking we're gonna be out of the woods every
For
moment.
3 years, we've been
Since
saying.
but because it looks like it's about to be.
Right.
Like it looks like one of the big metrics is like if you see a slowdown in housing constructions and new housing starts, typically it's followed by massive layoffs and then you can follow a recession. Okay. 3 times in the last 3 years, that has happened, but the massive layoffs did not happen.
Right.
And then the recession also did not happen, right? And there were lots of things that happened because of that, right? Like one is, all the military conflict.
Yeah.
There's, change in presidents. I mean, there's a lot of reasons, tariffs. I mean, there's a lot of reasons why we haven't quite gotten there. And then we just don't know what's next,
Mhm.
right? So if my assumption is that rates stay elevated like this, they're going to have to do something with taxes that motivate people to move out and lose their 3% rate. Like
Right.
either it's a tax credit, it's a reduction in the capital gains, taxes. I mean, there's got to be something. Now,
Mhm.
if interest rates come down, right? I think that in and of itself, and we have like a reduction in the Fed funds rate and people just have more capital to be able to just have. I think people are more willing to sell their house even and pay taxes.
Well, exactly. You have to think of it that way too, that they're still getting that $500,000 on the first $500,000 of profit. Okay. Then, and I'm not a CPA here, but I know that you can also write off any improvements you've made to the home. And a lot of people have moved into homes and put 100 or 200 grand into them to make them nice, right? That all goes into your basis. So, if let's say you're on the hook for $200,000 at 15% capital gains, 30 grand, and you just make 700,000 on your house over 5 years, not a bad deal.